Mike has over 26 years of experience advising private clients globally on investment strategy and cross-border financial planning. He's a chartered accountant, a CFA charter holder, and holds an MBA from Tel Aviv University and Kellogg. Mike works closely with investors, structuring international portfolios, including property in Israel, as part of a broader wealth strategy. Welcome, Mike. Good to have you on.
Thank you. Thank you very much.
Okay, so before we even get to property, let's zoom out. Many people think of Israel as sort of a smaller tech story or a very small economy. How would you describe the Israeli economy today to Australian investors?
Okay, I'm going to present some numbers to compare the Israeli economy to the Australian economy so people can get some sense of the relative size. But there's an important point I want to make at the outset, and that is that Israel is Israel. There's a tremendous amount of political noise, and too often investors look at Israel through that political lens. And because we're all exposed to the same international press, and that press tends to overstate the negatives, a lot of people are underinvested in Israel because of that political lens. The other aspect, particularly relevant for people living in Australia or outside of Israel, is that there's a knowledge gap. There's a tremendous amount of information available about the business community, about the economy in Israel, but it's in Hebrew. And a lot of investors, if you're only reading the Jerusalem Post or Haaretz, you're barely scratching the surface of understanding what's going on in Israel. So those are two important points that affect international investors. And for those of you who don't like numbers, just come walk around Tel Aviv and you can see the growth story for yourself. So let's just jump into some of the numbers that are prepared to show what's going on. I hope you can see the screen. I've compared four countries here, and I've taken 1993. Why 1993? That was the Oslo Accords, and their GDP per capita and their ranking in the world. So USA went from sixth to eighth. And this growth is in dollars and it's nominal. So it includes inflation, but it's still consistent across the four countries. Australia and Israel grew in parallel. They both went up the ranks. From Australia went from 23rd to 14th. Israel went from 25th to 17th. France went from 13th to 27th. So economic growth per capita is not a given across the world. So you can see on a relative basis, the Australian economy and the Israel economy are pretty similar. Australia is only marginally bigger on a per capita basis. But I think that the growth since 1993, the story here is that the Israeli population went from 4 million in 1993 to 10 million today. So it added 6 million on a base of 4 million. The Australian population went from 17 million in 1993 to 28 million today. So Israel absorbed a population growth of 132% and produced a GDP per capita growth of 335%. So the story is about growth. And that is very evident when you walk around Tel Aviv. Just to compare some other economic data points, we got GDP growth in Israel annualizing Q4 2025 was 4%. The outlook for 2026 is, according to the Bank of Israel, is above 5%. Last year was very erratic. We had the Iran war, so Q2 was poor. Q3 was a very strong annualized 11 or 12% GDP growth, but it's now settling down at 4 or 5%. Australia is a pretty constant 2%. Now, that gap of Australia growing at 2% a year and Israel growing at about 4 to 5% a year, that's going to compound over time. Unemployment is the number of people who want to work and who can't find a job, right? So in Israel, it's 2.8%. It's been pretty consistent through the war. In Australia, it's 4.2%, and that is on an uptick. The unemployment is definitely increasing in Australia on a year-on-year basis. Labor participation rate is an interesting statistic. In a developed market economy, you're supposed to have labor participation rate of above 75%. But in Israel, we've got the Haredi issue, which means we've got less people participating in the economy. But interestingly, Australia, who doesn't have the Haredi problem or issue, has a pretty low labor participation rate. So I think that shows the sort of welfare dynamics of Australia, and that's a bit of a negative. Debt to GDP, Australia has a very strong 51% compared to Israel's 68%. Throughout the war, we expected this to actually go over 70%, but it was maintained in the high 60s, which is pretty impressive. Debt to GDP, considering we're still recovering from a war at 4.8%, is excellent. The Australia's at 3.4. I think that's going to be under pressure. Inflation in Israel is at 2.6%. And Australia at 3.8%. Australia's tick is sort of trending up, and inflation in Israel is trending down. I think we can all agree that inflation statistics understate the real inflation, and that's why you want to be invested in real assets like property or stocks. Fertility rate is a big deal. If we take a 10-year view on Australia and a 10-year view on Israel, the population of Israel is growing. The population of Australia is shrinking. Now, the Israeli population growth, there's definitely a debate to be had there, but it's still a very positive number. In Australia, that shrinking population is going to put pressure on all the other statistics that I mentioned. Okay, now that's the economy, big picture. But now let's look at the capital markets. And to accumulate this data was a little bit tricky, but from a high level, the Tel Aviv Stock Exchange is approximately 40% of the Australian Stock Exchange in terms of size. However, in my opinion, that severely understates the economic activity. You have a lot of Israeli tech companies which are not dual listed. They go straight to NASDAQ. So, for example, Checkpoint, eToro, Monday.com, and a bunch of others, pretty significant companies. These companies went straight to NASDAQ and they're not reflected. So if you include these companies, now I know in Australia there's a couple of companies who also do it, who didn't list, especially tech companies, but it's to a much smaller extent than in Israel. And so if we include these companies and we say that the capital markets of Israel are approximately 50% of the capital markets of Australia, when our population is only 35%, then the capital markets per capita is actually bigger in Israel than it is in Australia. And that should be a source of comfort for Australian investors looking at Israel. Another interesting point, the Tel Aviv Stock Exchange is actually more of a bond exchange than a stock exchange. Bonds trade pretty efficiently. There's an electronic bond trading system where most of the world use over-the-counter and money and market makers on the bond market. So that's a little bit different. When you look at the largest companies on the Tel Aviv Stock Exchange, they're significantly smaller than the largest companies in Australia. But there's a significant trend there. I don't know if you saw the news last week. Palo Alto Networks, an American company worth about $110 billion, bought an Israeli company called CyberArk for $25 billion. And it's going to list, it's taking its listing, it's going to dual list in Tel Aviv and NASDAQ. So that's the first time that I'm aware where you see a significant global company wanting to dual list in Israel and wanting to access the Israeli tech market, which is a very, very significant step. It's a huge company, so it's actually 3 times the size of Teva. So we've got Palo Alto Networks coming into the Tel Aviv Stock Exchange at 3 times Teva, and it's going to rebalance all the index tracking products. So we're keeping a close eye on that. And it's a very interesting development, and I think investors should take a big source of comfort about that. Okay, that's economy and capital markets.
That's great.
Comparing.
Thanks, Mike. That's certainly very interesting. And I think the point you made about the population growth is certainly impacting the property market as well, just in terms of supply and demand in Israel.
Absolutely.
But Julian will discuss that a little bit down the line. I wanted to ask you, are there any misconceptions or risks that international buyers have when it comes to investing in Israel? In other words, when you compare Israel to other markets, I mean, I know you've given us a nice comparison here, but in dealing with clients, is there anything that stands out for you that people should be aware of?
Yeah, so that's the opening point I made about the political lens. Too often investors make a decision about investing in Israel one way or another, and they do it with a political overlay, and that's wrong. It's just fundamentally wrong. The political noise is not going to change. But if we look at risk metrics, Okay, so you can in the capital markets you can measure risk, right? Statistically, you can measure it through standard deviation, which is a measure of your volatility. And over the last 3 years, the Tel Aviv Stock Exchange, through the war, had a slightly lower volatility than the S&P 500 at 16% versus 17%. Now, the Australian Stock Exchange is kind of a very boring exchange. Its volatility is very low for a stock market at about 10%. And if you look at the returns, which is measured by and include returns, so that's the Sharpe ratio, which is your returns over your risk-free rate for each unit of risk. And you see the Tel Aviv Stock Exchange rewarded much higher returns in shekels for each unit of volatility. So the misconception about risk is that the Tel Aviv Stock Exchange is a lot less risky than people think it is. And those are the metrics. Another way to look at it is in long-term returns. The Tel Aviv stock market on a 1 year, okay, so we had a very big bounce back in 2025 at the end of the war. But on a 5 year basis, which includes 2022, which was a global sell-off, and the 30-year basis, which includes all the political drama of Israel, the Tel Aviv Stock Exchange has outperformed the S&P and significantly outperformed the Australian exchange in their own currencies. Now, add to that the strength of the shekel over the last 30 years, and you have significantly outperformed. So I think that the misconception there is the Tel Aviv Stock Exchange is actually a very good place to be. You need to push aside your political concerns and focus on the economy and invest in the Tel Aviv Stock Exchange. I think the evidence stands for itself.
Mike, you mentioned the shekel. It's been remarkably resilient despite a very tumultuous couple of years. What drives the shekel strength?
Okay, this one is it is interesting. So every currency has a domestic effect and a foreign effect, and in the shekel case, both are working in the shekel's favor right now. The domestic effect is what's is a bigger influence than the international effect. So non-residents, both private individuals and institutions, are investing in Israel more than ever before. So we can see from the interest in this webinar that kind of supports that story. And we know, I know from our business that there's an uptick in interest in investing in Israel. So that strengthens the shekel. Then we've got weapon and gas exports. We've sold missile defense technology to Germany and Saudi Arabia, very significant numbers. We've renewed our gas export contract with Egypt, also very significant numbers, and that adds to the shekel strength. Then high-tech investment, even though it slowed down during the beginning of the war, it came back with a massive investment in the second part of 2025, really significant numbers. NVIDIA is building a massive research and development place in Yokneam. Google bought Wix. I mentioned Palo Alto buying CyberArk. So huge numbers of high-tech investment into Israel. Another reason why the shekel is strong, which is seldom appreciated, is prior to the war, we had the political reform, which weakened the shekel. So prior to that, the Bank of Israel would intervene in the currency markets to artificially weaken the shekel to protect the high-tech industry. Now, the political reform started, so the shekel weakened. Then the war started, so the shekel weakened. So the Bank of Israel didn't need to intervene. And then Trump came along with his tariff policy, and he said to all governments around the world, do not artificially protect your currency. And the impact of that is what looks like a weakening dollar, but the currencies are actually trading more freely now. And this is without Bank of Israel protection of the shekel's likely to stay strong. Another underappreciated point is the pension industry in Israel. Israel has a very high compulsory savings rate. So if you employ someone for, say, 10,000 shekels, it's going to cost the employer 35%, and the employee is going to save. So approximately 40 to 45% of the payroll check every month is going into the pension industry. And that pension industry is growing every month as the economy is growing, as the population is growing. Now, the pension managers who are like me, who are managing money, they like to allocate a significant amount of money into the US, into whether it's to NASDAQ or S&P or to direct names, and they hedge the currency exposure back. So they're buying shekels to hedge their currency. Now, these are very, very, very significant numbers, and they are the biggest players in the currency market, and it's seldom understood. So the pension industry is only going to grow if the economy grows, which we assume it is, we think it is. So that hedging is also going to constantly keep the shekel strong. And again, these are economic fundamentals which overrule the political thing. People tend to think of the shekel as politically influenced, but there are very, very strong economic things going on. And those are the economic trends which keep the shekel strong. On the global side, the dollar's looking weaker. I think it's got to do with the tariff story. And the outlook for the US dollar with excessive levels of debt, again, is an international effect, which is going to keep the shekel strong vis-a-vis the US dollar. And when we look at the Australian dollar versus shekel, which is more relevant for the people on this call, there's a very clear trend as well. Now, the Australian dollar, US dollar had a little bit of a wobble in 2015, 16, 17, as you know. But since then, it's been relatively stable. So the Aussie dollar, the economy is growing slowly, the population is growing slowly, the debt to GDP is not changing. So there's not much happening on the Australian dollar side. If I have to take a 10-year view on the Australian dollar, I would say it's going to be slightly weaker, but not materially weaker. But there's a very clear long-term trend here when you look at the Australian dollar versus the shekel. Now, for investors in Australia who have built their wealth primarily in Australia through property, through their pension, through their stock exchange, they're looking for something to diversify away from. And I think the shekel, before you start looking at fancy things like gold and Bitcoin and things like that, you should consider the shekel as simply from a diversification point of view. And that's on the currency side. Whoop, you're on mute.
Mike, we had a question about what happens to investors worried about currency risk.
Okay, so currency risk is a very difficult thing to get right. And what you want to do is reduce your reliance on luck. Okay, so you really have to match your liabilities. If you're going to commit to a property development project, which may take several years, you really want to match those future liabilities. I have a client who committed to a 12 million shekel development 3 years ago at 3.6. And had he not hedged the currency risk there, had he not made the shekels available then against his future liabilities, that property would have cost him 14 million shekels at the end. So it's very important to match that. How you do it, I like to recommend to clients to average in over time, so you're not making a big decision, and try to use spikes in the rate, which occasionally will come, and to move slowly, but very important to match your liabilities in the currency. There's enough risks out there. You got to remove that one.
Amazing. So let's talk about property versus financial assets. If people are deciding to buy property, what would you advise in terms of investing in the financial market, stocks or property?
Okay, so I get asked this question a very lot, and it's the answer is you need both. Okay, you need both a physical property, but it's from an investment point of view, it's an apples versus oranges comparison. It's not a good comparison because there's very different investment criteria. On a property, you can have leverage. Your rental yields are relatively low. So if you're looking for cash flow, maybe a bond portfolio is better. If you don't have enough money for both property and capital markets, then you need to prioritize based on your needs. So as I say, currently, bond yields are higher than rental yields. However, they weren't always the case. There was a good number of years where bond yields were below rental yields. So it's dynamic and it changes. If an investor has enough money, you can definitely, you should do both. You have both physical property and your liquid assets, which give you flexibility.